Happy Monday out there, Team 42. It's your skipper here, Darius to present our macro minute for Monday, September 16th, 2024. Hope everyone had a good weekend. As always, we'll start with our executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are, will asset markets respond well to this week's key central bank decisions? And will Beijing finally unleash a major stimulus program? Our answers are, on Wednesday, the Fed releases its latest policy statement and a revised dot plot ahead of Fed Chair Jay Powell's presser. U.S. dollar money markets are currently pricing in a 53% chance of a 50 basis point rate reduction by the Fed. On Friday, the Bank of Japan meets for the first time since hiking its target rate in late July. The Bank of Japan meeting will be the one day after Japan's August CPI data are released. Any upside surprise would send a message to Bank of Japan Governor Kazuo Ueda that recent yen strength is not having a depressing enough impact on inflation to justify delaying policy normalization amid a near 30-year high in wage growth. As such, we believe the risk of the Fed cutting less than the market expects and the risk of the BOJ hiking more than the market expects are both elevated. That implies the risk of incremental yen carry trade unwinding is mispriced after last week's risk-on pricing in asset markets. China's August activity data indicated the Chinese economy was slowing faster than consensus expected. For the 42 Macro China liquidity proxy, which is the PBOC's balance sheet plus China's broad money supply plus the PBOC's foreign exchange reserves minus gold with the bond market volatility overlay to account for the repo market activity there. That indicator indicates China's liquidity impulse is finally picking up after having been muted since the late spring. The September data will better clarify Beijing's intentions amid a fresh Fed rate cutting cycle. In our view, Beijing is running out of time to send a clearer message that forceful stimulus is on the horizon, either with its words or through China's stock market, which is down 15% since peaking in May. Transitioning to our 42 Macro dashboard here, this one's got a question here regarding our KISS portfolio construction process, specifically why we chose AG instead of TLT. It says, hi Darius, can you please let me know why you chose AG rather than TLT for the KISS portfolio? Seems TLT would outperform AG during deflation due to lower credit risk. Why am I wrong? Thanks for all your hard work and keeping us all informed. So rather than me answer the question, he actually had another client answer the question, probably with more detail than I would have had time to reply. So I'm just going to read the answer there just as an indication of the kind of education and collaboration that's happening behind our paywalls here in our community. We have so many investors. So one of the things that we do pride ourselves on here at 42 Macro is that we sell the exact same research to investors all across the sophistication spectrum for the exact same price, and everybody gets the exact same thing all at the same time. Obviously, we focus and target the various aspects of our research to the various investor cohorts: retail investors, sophisticated retail traders, institutional investors, hedge fund managers, mutual fund managers, insurance portfolio managers. We have all these different types of clients, and we have different aspects of our research that are designed to communicate specifically to them. And so, one of the things that we're really most proud of is that we have clients all across the sophistication spectrum interacting with each other, collaborating with each other, and educating each other in this community. So we're really grateful for that. And so rather than me answer the question, I'll just read verbatim what the other client answered. It says, hi, Gregory. Short answer is that Darius' preferences for broad exposure to the fixed income asset class and what most Darius has a preference for broad exposure to the fixed income asset class, and that would most represent the average investor's exposure. We've been over this a few times in the past or so, so perhaps search the forum if you want more depth. There's obviously a search function in here. And Darius encourages 42 Macro subscribers to substitute their own preferred exposure as appropriate to their circumstances and risk appetite. So as you know, our KISS portfolio construction process, that's our systematic 60-30-10 trend following approach to SPY, AG, and Bitcoin. Investors who have different risk profiles, investment preferences, different investment objectives, obviously can substitute those ETFs and to diversify into different ETFs or a basket of different ETFs. And we make all the information available on a daily basis, the information that they need to execute the top-down and bottom-up risk management overlay pivots featured in KISS. We make all that information available so that they can execute those same pivots across the ETFs that they diversify into away from SPY, AG, and Bitcoin. So we're really proud of that. So we have thousands of investors around the world following KISS and or implementing some customized version of KISS for their own clients and their own families. So I'm really proud of that. So getting back to reviewing this response, For instance, this investor has been using 50-50 SPY and NASDAQ for equity exposure and some TLT in the fixed income space until a few months ago. To implement a modified KISS, you just need the VAMs for that ETF on the discretionary risk management overlay page, aka Dr. Mo. Happy hunting, Gregory. And side note, this the response goes on to read. Side note, be careful with assumptions around which bit of the yield curve may move and how much as the market comes to price in a rise in inflation and debasement risk, especially if we see changes to bank requirements under Basel IV next year. Ag exposure to the belly of the curve may turn out to better capture appreciation if your outlook is short to medium term. Perhaps not, I'm not smart enough to know the answer, but duration on TLT will magnify the outcome either way. Personally, I'm not prepared to swing that hard on this one. So again, it's just a phenomenal example of the kind of, sort of institutional grade learning that has taken place behind our paywall here amongst our client base. And obviously, I spend a decent chunk of my time every day interacting and answering questions for our clients as well. So really proud of this, really proud of our community, and really thankful for our community. So we just want to wrap that, highlight that today, and send you guys about your merry way. So everyone have a wonderful day. Best of luck out there. Have a great day. And let's go Seahawks 2-0. Luck in that. Cheers.